From Kansas State University, this is Agriculture Today. Eric Atkinson with you. K-State's Dan O'Brien is standing by to talk about the wheat market's push toward still higher ground despite lackluster export business of late, and he'll remark on whether corn prices have hit their post-harvest low, this during Dan's weekly segment on the grain market trends. He'll be followed by K-State's Allen Featherstone. Allen discussing the current concerns over economic inflation in the U.S., what it means for the agricultural sector, particularly when it comes to the outlook on interest rates. He took up those and other topics on agriculture and the macroeconomy at a recent forum at K-State's IGP Institute. And further ahead, to cover the latest Kansas agricultural weather outlook, K-State's Chip Redmond. All that next on Agriculture Today. This is the K-State Radio Network, and you're tuned to Agriculture Today. Thanks once more for being along with us. Into the grain market scene we go with comments from grain market economist Dan O'Brien, K-State Research and Extension. As we look across the spectrum of the grain trades, wheat, Dan, is the front runner right now, and that's despite slow exports. What's going on?
Well, I'd say when you kind of break apart the price directions, both in the futures and the cash basis, and then look at the supply-demand fundamentals, you have a kind of a mixed picture of things. Without question, you look at these major futures contracts that we're looking at. The Dees hard red winter wheat, which closed yesterday at 747 and 3/4, and in a strong uptrend, not abating at all. If anything, accelerating of late. We took out highs of last April that were in the 725, 735 area, and again, gaining 20 cents on top of that. So strong wheat prices on the future side. To go with that, you see cash prices in Kansas for wheat, for any unsold cash wheat that might be out there yet, and I guess it's only October. After harvest, there probably is a fair amount that could still be lured into the market by buyers. But running from Colby at 760 to Salina at 784, Topeka 784, Hutchinson 784. That's the top end price that I could see in the areas. A lot of those are at terminals. And then seeing also Garden City at 770, Columbus 739, the Columbus area down that southeast corner. You see very strong basis bids for all those areas except for the southeast corner. That 784 is a 6 under bid, and you're just knocking on the door of 8, and people wondering where it might go from there. I would say when you glance at where new crop bids are at, they're also tremendous historically. The highest of them is Topeka at 754 new crop bid. That's a 25 under basis. But then you have bids at Hutchinson at 745, 34 under, 740 in Salina. And again, these are export and milling oriented locations. You do see at Colby 739, Garden City, Colby and Garden City both 739, both 40 under, as well as is Columbus at 739. Concern I have is that, again, we've got tightness in the world, anticipation of how any price weakness in the U.S., given what's happening in the broader scale, will be met with pretty aggressive buying. So I understand all of that, but yet our actual pace of shipments isn't that strong. In the week ending October the 21st, we had just under 7 million bushels actually shipped. We need a pace of about literally 18 to meet the USDA's latest projection of 875 million bushels for the marketing year, and we're 21 weeks into that. 22 actually now. That USDA data trails. And in terms of what's been bought, he had about 53% of that USDA projection bought, and we're about 40% of the way through the marketing year. And that's just kind of positive, neutral to positive. So I'm not trying to talk down the wheat market, but I think broader concerns about production problems elsewhere in the world and thoughts that might lead to a lot of buying in the U.S. are probably more the issue that's holding up the market than the actual shipments that are happening. So there's a little bit of vulnerability there at these high prices. And maybe the high prices are holding off purchases. That could be happening. But if you're seeing that, then you wonder about tops coming in the market, or at least a pause until the rest of the world catches up. And so we're talking about pausing at cash prices 784, just under 8. Right. Well, I guess this comes with the territory.
Not a bad place to park if you're a wheat producer, that's for sure. Corn now is showing a tendency toward the upside, that market. Once more, exports are sluggish here, but perhaps you say this is reflective of what we see happening in ethanol revenues now.
Yes, the ethanol side is doing really positively. By our calculations, looking at Iowa State models and numbers for that part of the world, or part of the U.S. where most of the ethanol plants are, and that in Iowa in particular, but also Illinois, whatever, we calculated about a 47-cent per gallon profit in the last month. And that's not with cheap corn prices at all. The inputs are strong, just as you've been talking about for corn. And in fact, they averaged through October so far have averaged just about $5.21. So that being down a little bit. So that is as is. But what's really been strong is ethanol prices. Distillers' grains have actually weakened some, but when you look at a chart of where ethanol prices have gone, we have that in our supportive notes. We're at the highest level we've been at since basically the real glory days of back in 2013 and 14. So shooting to the higher side in areas we haven't been for a while, and here this month at about 47 cents profit, and an estimate last month of about 24. First time in about 18 months we actually have shown any profit in that industry. So here we're harvesting corn, ethanol, with strong fuel prices holding up well, and that's really positive. In terms of corn exports, we're just kind of so-so by my calculations anyway. We had a pace for the week ending the 21st of October, about 27 million bushels actually shipped, and we need a pace of about 52 to really meet the USDA's projection of 2.5 billion bushels. So ethanol strong, exports not much yet, but looking like it's going to come. We do have pretty good forward purchases, about 47% of the way to the USDA's projection, bought ahead. That can switch out, but bought ahead, and about 15%, about 8 weeks of that market year going. So prospects looking better for corn than they are for wheat, really. I would also say that we're kind of in a waiting mode also for the grain sorghum exports to really come to town in quantity. I would also say that in driving out of western Kansas, I see sorghum coming out of the fields now. So the time for sorghum to really start moving is probably be when that crop's largely in the bin, and that's in 3-4 weeks probably. I'm just guessing. But there's a lot of sorghum still to be cut in different parts of the state, and we really can't expect fireworks in that market yet until we've got the supplies ready to head down the river or on rail down to the ports, and then we go from there.
Yeah. Before we move on to soybeans, Dan, to ask here, with all of this happening, is the post-harvest low already in for corn?
Well, by what the futures are doing, the futures are for corn have, they closed yesterday at 562, and they were down to about 510 here 2 or 3 weeks ago. It got down to low of 5. So the general attitude of the market towards large supplies coming in and everything just crashing down seems to be past. That's what happened in September and about 2, 3, 4 weeks ago. So I guess we're, as some would say, we're, quote, riding the wave, Eric, in that if there's another low coming, you'll have to have a real reversal of the train of thought in these markets to have it happen. But of late, trend moving higher. And I do read on the commentaries that there's a general thought that the USDA's projection of usage is too low. We'll have that November report coming in November the 9th. Mm-hmm. So stay tuned. I guess we'll have more information on what the market sentiments right now for corn are in terms of actual usage coming in better than what the USDA says. They have a little better picture of that once we get to that November report, and it's just a time of more potential volatility in the market, either higher or lower.
Now to beans, and interestingly, soybean exports are good, the converse of what we see in corn and wheat, but there's just not much traction as far as prices, Dan.
I think the general issue, it has to do with, well, on the one hand, the expectation we're going to plant a lot of acres of soybeans next year, so people don't have to be quite as far bought ahead to try to protect themselves from that. And in South America, they've had some rains, with the feared La Nina patterns that could still emerge and damage that crop. haven't held off rain so far, so they're planting. They have moisture down there. And if they're underway with that, then we start to see supplies coming out of South America latter January on into February. So when we see a weekly export like we just had on October the 21st of 88 some million bushels, and we need 41 for the whole marketing year weekly average to get there, really that's kind of a deceptive number. We, in essence, we've got a 6-month marketing year. So if we have 88 now, we probably need double the 52-week pace to match a 26-week pace. So we need about 80 million. So it's still positive, but it's got to be gangbusters. And there's got to be problems in South America for that market to really take off. And there's been some major buyers, China in particular, has been really hesitant to get much involved. We're not talking about it much today, Eric, but you keep reading about economic issues in China. If their economy is struggling, and if it is struggling, it'll be more than we're told, given the way that the Chinese government handles information. They're very secretive about it. That's kind of a harbinger out there for us to be wary of. These world markets are so dependent on what China does. And we've always kind of rested our hats on the idea that, well, they have a lot of people and they're going to have to feed them and they'll roll out the checkbook and buy whatever they have to. Still think that's true. But if they're struggling with their financial sector, then it takes away some of the outstanding optimism about where world grain markets could go if China struggles and feels it has to economize some in what it's buying.
And again, producers, glance at Dan's notes on the markets put together for this week at agmanager.info. Good insight as always, Dan. Thanks, and we'll talk again next Friday.
Great. Eric, take care.
You as well. Dan O'Brien, grain market economist, K-State Research and Extension, with us here on Agriculture Today. Agriculture Today continues now. Well, it's a daily mainstay of discussion in the media, at the coffee shop, just about anywhere else you can think of, the state of the U.S. economy, and highlighted within that, the trend toward higher inflation, as evidenced by rising prices for just about any purchased good these days. At a recent Grain Market Outlook Forum hosted by the IGP Institute here at K-State, one of the presenters tied these macroeconomic forces back to the farm and ranch, what they mean for the agricultural economy. Allen Featherstone is the head of the Agricultural Economics Department at K-State, and we've for you here some of the comments he made on that subject.
Inflation is up. We've seen the September year over year has increased 5.4%. And if you go back and look at that, that's roughly the largest increase in 30 years for the consumer price index. Certainly, people have an interest in terms of where is the macroeconomic economy going forward. The University of Michigan ends up doing a monthly price expectations, and they've been doing this all the way back to January of 1978. Information that the University of Michigan has published indicates that essentially the mean expectation for price increases by the public over the next year is 6.1%. So there are some individuals out there that have a pretty high expectation of what inflation is going to do over this next year's period. Certainly you're looking at high levels of expectations, at least from the University of Michigan survey, of about something we haven't seen in 10 to 13 years.
And while those higher costs for inputs clearly impact producers, Allen remarked on the longer-term item of importance for production agriculture.
The important thing to realize is that eventually inflation is going to affect interest rates. And we haven't seen that as of yet. The real interest rate is probably about 3 to 4% below what it normally is. And so normally if you look at what the real interest rate is essentially the interest rate will be 2 to 3% above the inflation rate. And so that's the return that you're going to get after inflation. And so really one of the key things I think to look for is how long are investors going to accept a negative interest rate for lending. From a borrowing perspective, it's good in terms of essentially you're borrowing money at 5 and 10 years, essentially less than zero. And so you're paying a negative interest rate. And if you look at these across economies across the world, if you have economies that have high inflation rate, you will see high nominal interest rates in their economy. And so the key thing is, and we haven't seen this as of yet, when inflation increases, the market or nominal interest rate also will ultimately increase at some point in time. The other thing I think it's important to realize is these rates are still historically low in terms of 30-year money, 10-year money, 5-year money, 1-year money is extremely low. And so to look at this, the real interest rate summary, again, there was a spike when the pandemic hit, and we have seen a consistent decrease in the 5 and 10-year inflation-adjusted securities since then. And they are historically low, and they're basically at a negative real lending rate. And so the question is how long are investors going to take a negative return on treasuries after adjusting for inflation?
Reading the tea leaves, then, Allen suggests that the current inflationary tone in the economy may have its limits.
The markets are kind of agreeing that this is transitory at this point in time because you haven't seen a huge run-up in those expectations. And so normally the 10-year inflation rate expectation is higher than the 5-year. But if you look at kind of what's gone on, that's flipped. In terms of essentially the 5-year expectation of inflation is higher than the 10-year. And so again, the implications there are that the market is expecting a higher inflation rate in the short term than it is in the longer term. And so again, when you look at the Michigan information where consumers are really feeling it, essentially those that are trading these on Wall Street are saying, yeah, inflation is a little bit higher, but it's not anywhere near that 5% type rate. And so at this point, the market still assumes that this is a transitory type situation.
Again, then, how does all this funnel down into implications for the agricultural economy in specific? To address that, Allen centers on what he says is an important indicator.
One of the things that I track is what is the cost that Farm Credit acquires their money at? And this is kind of a weekly indication here. 1-year money is pretty close to 0%. 10-year money, they're paying about 1.5%. And 30-year money, they're paying 2.5%. And so these rates are fairly low in terms of what they acquire their money at. The issue is in terms of how much they mark that up as they turn that around to farm loans, but at least when they go to Wall Street to look at their money, you can see that they have followed the treasuries and a lot of faith in the agricultural economy with regards to what investors are willing to lend to farmers. Those that are investing and providing funding to the farm credit system to be relent to agricultural producers and agricultural co-ops basically view the sector as being extremely safe.
Couple that with the general condition of the agricultural economy, at least by K-State's numbers, and Allen thinks that producers are on pretty firm economic footing right now.
Essentially, the agricultural economy is good. In terms of 2020, you saw a big increase in the Kansas Farm Management Association numbers. The actual net farm average income for farmers in the Kansas Farm Management Association was $166,000 per farm. And so certainly it's pretty much the high that you've seen in nominal dollars. The other thing that I track is I have a credit assessment model. And one of the things we see with credit assessment is we saw an improvement. Essentially, the probability of default improved, and essentially the last 3 years have been pretty decent from a farm perspective in terms of turning that around. We saw a pretty big increase in that from 2013 forward. But again, the situation is positive. Looking at just some 2019 and 2020 numbers, essentially net farm income popped up from 2019 of $114,000. It popped up to $166,000. In terms of the probability of default, dropped 0.2%, and that's a pretty big drop for an individual year. That's a 10% move in that probability, and so that's a pretty high number. Debt to asset ratio, Kansas farmers continue to pay debt down. It went from 27.6% to 25.4%. In terms of working capital increased by $50,000. And so the liquidity as farmers went into this year was very good. And then repayment capacity, ideally you would have 100%. I would say probably about 60% of the years or 70% of the years, farmers do not generate enough income to pay principal and interest. In 2020, anytime you get a number over 100%, that means that you have 17% more cash on hand to pay principal and interest. And so that's a good thing from a banker perspective. It's a good thing from a farmer perspective. It's a good thing from an economy perspective.
And will that good standing endure in the months ahead?
Going forward, we've done some work that basically suggests that farm income in 2021 is going to be about 22% up from 2020. What's interesting is most of that's going to be from the market, and very little is going to be from government program payments. And we went from about $100,000 in government payments in 2020 to virtually zero in 2021. In terms of as an economist, that's one of the things I always worry about. It's much more comfortable having income from the market as opposed to the government, simply because it's usually less susceptible to the vagaries of politicians. 2022 kind of going out, using futures prices in that. We're actually going to expect to see a little bit of a drop from the 2020 numbers. If you take the 166 and knock off 20, that would be roughly 32,000 off the top, and so that would get you kind of in that 120 to 130,000. Obviously, there's a lot that can happen in 2022 that will make these estimates wrong. But in that perspective, if we look at the markets out for the 2022 harvest, assuming normal yields and all of that is heroic assumptions in Kansas, we increase the input prices some. But essentially, 2022 likely won't be as good as 2021, but it will be in a fairly reasonable shape in terms of most times if you would tell farmers that they can expect a net farm income over $130,000 going into a year, that's a good year from a producer perspective.
Remarks there from Allen Featherstone, K-State agricultural economist, at a special grain market outlook forum that took place recently at the IGP Institute here at Kansas State University. For more details, you can hear a podcast of Allen's entire presentation. You can find that at agmanager.info, agmanager.info. This is Agriculture Today. Now for you on Agriculture Today, Kansas agricultural weather and the latest from the Weather Data Library here at K-State. Once more on the line with us is Chip Redmond, meteorologist with K-State Research and Extension. Beginning, Chip, as is sensible, with the moisture update for this past week. Central and eastern Kansas had good fortune in that respect, but western Kansas, not so much. Is that the general gist of it?
Yeah, unfortunately, kind of the same thing. I mean, we'll take the moisture in the east and central. We definitely need it, especially in those areas that were in drought and were drought expanded over the last couple of weeks in north central Kansas and along the southern border of Oklahoma. But, man, the west just keeps missing. We had upwards of 3 to 4 inches of rain in southeast Kansas over the last week. I know the Manhattan area ended up with around 2 to 2.5 inches, and as you get further west, the amount started tapering off, with the line pretty much being from a Barber northward to about to Smith County, and then west of there just was a lot more isolated amounts.
Once more, a fair amount of this is not captured in the drought monitor for this week, which ends as of this past Tuesday. But this had to, as you say, help north central Kansas, south central part of the state that was a little dry. What about the rest of the state as the monitor reads right now?
Yeah, so the southeast got moisture before the cutoff, so we had abnormally dry and a moderate drought trimmed from Parsons and Cherokee County. Mm-hmm. You know, we didn't have any change in the drought monitor except for a small area in Sherman County where we expanded the moderate drought to match up with Colorado. Overall, though, the state was pretty status quo. We were normal temperatures. We didn't have very much wind, and so our evaporation rates were low. And this time of year, our typical average precipitation is dropping every week still. And so when we start getting no rain in a week, we don't see as big of impacts as we would in like July or August. Now, this rain that we did get is going to help north central Kansas and parts of central that were abnormally dry, that were kind of on the tip of just kind of flipping over to wet conditions. So I expect to see some improvements in central Kansas and most likely north central Kansas next week as well.
And where it did fall, the rain was a blessing, certainly, for our winter wheat crop in Kansas. Couldn't have been more timely for a number of fields. Temperatures, Chip, pretty much what you'd expect for late October?
Yeah, we're sitting right there. We're getting behind on our freezes, but I think we're going to make up for it pretty quickly. Most people most likely won't freeze going into this weekend, but next week we have a pattern shift. We have another cold front come through early next week that is going to bring a shock to the system. It's going to bring much colder temperatures. And by much colder, we're talking, actually getting below freezing for most of the state. Mm-hmm. So I expect by the time we talk next week that most of the state will have seen their first hard freeze, and people will have their true test of their furnace.
And we'd remind folks, don't forget about that freeze monitor on the mesonet.ksu.edu website. There's even mention of the four-letter word in the forecast, at least for parts of Kansas next week, snow. Chip?
Yeah, it always sounds ominous when we haven't seen it for 6 months, 8 months. But, there's definitely some chances of snow. I don't expect any significant accumulating snow. At this point, looking at precipitation amounts, the Climate Prediction Center has us above normal precipitation for the whole state, even western Kansas going into the 6th of November. I'm not too confident in that at this point. We're going to kind of transition to a colder northwest flow over the central plains, and that tends to be a drier flow for us. Mm-hmm. So while we might have some snow showers and some rain showers, the snow should be limited mostly to the western part of the state. I don't expect significant amounts.
Well, when we next talk, we will reflect on just how cold it got and where, as that much colder weather is set to roll in next week. Chip, thanks for the outlook. We'll talk again next Friday.
Sounds great. Thank you.
K-State Research and Extension meteorologist Chip Redmond with us. Our time's away once more. Thanks for tuning in, and the best to you this weekend. Eric Atkinson for Agriculture Today over the K-State Radio Network.